we have a community question that has come through from Eleni that we will answer in a moment. A reminder that if you would like to ask a question, there'll be a link in the show notes or in the description below. We love hearing from you, so please leave a voice note. But let's take a listen to Eleni's question.
Hey equity mates, could you please compare the Vanguard Diversified High Growth Index ETF to the BetaShares Diversified All Growth ETF? I have my safety funds all set up and want to start investing. My plan is to invest a $5,000 lump sum upfront and then dollar cost average roughly $200 weekly. I want to invest in something that I don't have to think about and can just let grow. Which of these two ETFs would you invest in for this scenario, or do you have an alternative suggestion? Thank you.
Great question, Eleni. Thank you so much for sending that in. And she's chosen two of the most popular ETFs that are in the Equity Mates community, VDHG and DHHF, both of which we classify as or call your all-in-one ETF. Now, Ren and I spoke about a core portfolio earlier. These are essentially pre-made core portfolios. Both of them have underlying ETFs that are then put together by the managers to give you access to effectively thousands of stocks globally.
Yeah. So to be really specific about that, they'll have a Australian funds section, which might be, depending on the ETF, about a quarter of it. Then they'll have international stocks, so it might be another quarter to a third. They'll have
emerging markets.
They'll have emerging markets. VDHG will have a little, about 10% allocation to bonds. And so that way it's all in one because you don't need to buy other things to be diversified. That product is diversified across, countries and different market sizes in terms of small caps, large caps.
So let's look at some of the key differences. You always got to look under the hood. You can find all of this information on the issuers' websites. But we've got to start with asset allocation because there is a slight nuance between the two. The Vanguard ETF gives you 90% exposure to growth assets, or effectively shares and property, and a 10% exposure to defensive assets, which is bonds. If you compare that to BetaShares DHHF, it is 100% exposure to stocks. So no bonds in there.
Yeah.
Secondly, you then got to look at the management fees. So VDHG 0.27% per annum. DHHF is 0.19% per annum. And then geographic allocation. We both just said that it gives you global exposure. The nuances, the Vanguard has a higher allocation to Australian shares, about 36%, whereas DHHF has a little less, 27% of the ETF gives you exposure to Aussie shares.
So let's put that together and have a look at the performance of the two ETFs. So DHHF was launched in 2020. Since inception, it's up 12.05% a year. Pretty good.
Yeah.
VDHG was launched in 2017, so it's been around a little bit longer. It's seen a little bit more market turmoil, but a little more growth as well. It's up 9.4% a year.
Yeah.
So DHHF has grown faster. The question is why? Two big answers. First of all, VDHG has more exposure to Australia and therefore less exposure to the US. And the US has really been the growth engine of the past, call it decade.
Yep.
And then the second one is VDHG has a 10% allocation to bonds. Yeah. And actually this allocation to property probably has slowed it down a little bit as well.
Yeah.
So, 12%, 9.5%, it is a meaningful difference over time.
Yeah.
And to give you a sense of what that difference looks like, I just used the compound interest calculator. So Eleni has a $5,000 initial deposit and then is investing $200 a week. And I said over 30 years, let's use 30 years as the time horizon. 9.5% will get her $1.6 million.
Yeah.
Love that.
Yeah.
Nothing wrong with that.
No.
But 12.1%, $2.7 million.
Wow.
So it's an extra $1.1 million.
Ooh.
So like those small differences really do add up over time.
That actually makes a significant difference. So, in terms of the specific situation, Eleni, love the strategy that you're going after. $5,000 upfront, $200 DCA weekly. I think nothing wrong with that strategy as a core. You mentioned that you've got your safety fund set up. I assume that's your emergency fund. As we've said in our foundational series over on Get Started Investing, make sure you have your emergency fund set up before you start investing, so you are well positioned to get stuck straight into it. I would say DHHF is perhaps more suitable if you've got that super long-term horizon. Fees are slightly lower, and you don't want so much exposure to the Australian share market. It's 100% growth assets. If you're young and you don't need to be so defensive, then for me, this is the one that I would prefer. Having said that, VDHG is still a great solution. Does have a little bit of bonds in there, so is a little bit defensive, less volatility. And if you love Aussie stocks and want to take advantage of some of the tax situations around franking credits and the like, there's a little bit of a nuanced advantage there as well.
Yeah.
But I think both of them offer a great starting point for a core portfolio.
Yeah, I agree. So get started is what I'd say.
Yeah.
And if you're in a similar position to Eleni, you don't need $5,000 up front or $200 a week to get started with this. Platforms these days, you can get started with literally $1 on some of them. Yeah, there's no excuse is what I would say to make 2025 the year you start investing.
That's it.
Or continue investing.
Yeah, whatever. Or go harder.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.